The stage is yours, Mr. William.
Thank you very much, and thanks for the opportunity. My name is William Tomé, and I'm the interim EMEA MD at CFA Institute, and I'm in charge of the MENA region, also at CFA Institute. It's a great honor and pleasure to have esteemed and very smart guests today. I'll start by introducing them throughout their shortened bio, and then later on we will open the floor for their presentations. We have the honor to have Mr. Joffrey Odundu. Mr. Odundu holds a master's degree in strategic management and an undergraduate degree in mathematics and economics. He's an advanced management program graduate from Southmore Business School. Mr. Odundu was appointed Chief Executive Officer of the NSC on March 3rd, 2015. He is an accomplished investment banker, having been in the financial services sector for the last 28 years. 22 of which have been in the capital markets. He's the Vice Chairman of the REITs Association of Kenya, a member of the Working Committee of the World Federation of Exchanges, a member of the Central Bank Consolidative Forum for Domestic Debt Market, and a council member of the Institute of Certified Investment Financial Analysts, a member of the Steering Executive Committee of the East African Stock Exchanges Association, and a member of the Thomson Reuters Africa Customer Advisory Network. Welcome to the panel. I also welcome Mr. Thapelo Cheole. Mr. Thapelo is Vice President, ASEA, and Chief Executive Officer of the Botswana Stock Exchange. Mr. Cheole is a seasoned financial markets expert, with a cumulative experience of over 19 years, having worked for the Central Bank of Botswana and Botswana Stock Exchange. Mr. Cheole holds a bachelor degree of social sciences from the University of Botswana and a Master of Commerce in financial markets from Rhodes University. Further, he holds a master's degree in business administration from the Graduate School of Business, University of Cape Town. Mr. Cheole is the chairman of the Committee of SADC, Stock Exchanges, and the Deputy President of African Securities Exchanges Association. As a result of his extensive experience, he serves as a member of the Africa Integrated Reporting Committee, a joint initiative between Pan-African Federations of Accountants and World Bank since July 2017. I also have the pleasure to welcome Mr. Nasser Siddiqui, Director of Corporate Finance and Markets, AMC, Morocco's Capital Market Authority. Mr. Siddiqui is the Director of Corporate Finance and Markets at Autorité Marocaine du Marché des Capitaux, the Moroccan Capital Market Authority. As such, he supervises the authorization of offerings on the capital market, the monitoring of issuers' ongoing disclosure, as well as the oversight of market participants and infrastructures. He is also in charge of other cross-sectorial activities to support the development of the Moroccan market, such as various initiatives in the fields of sustainable finance. Mr. Siddiqui has a French diploma of Chartered Public Accountant, as well as an extensive international professional experience of more than 20 years. We also have the honor to welcome Ms. Shanti Divakaran. Shanti is a senior financial sector specialist at the World Bank Finance. Bank's Sovereign Wealth Fund Secretariat. Ms. Shanti holds an MBA from the Yale School of Management, among other certificates. Thank you very much. As gentlemen, we would start with ladies first. Dear Shanti, please feel free to share your presentation and educate us. Thank you.
Thanks so much. Thanks so much, William. Thank you very much to all of you. I think my presentation is online, yes. So I'm really delighted to be here for this very important discussion. I'm going to be providing a quick overview of SME exchanges, equity-focused SME exchanges before my colleagues, my practitioner colleagues, talk about the specific context in which they're set up. So let me just tab over 1 second. Okay, actually, can I just ask, Ayub, would you be able to go to the next slide if it's possible, because I can't seem to tab over. Oh, I got it. Okay. So first, let's start with what is an SME exchange. It's basically a niche solution for a subset of SMEs. It's a part of an array of financing solutions that range from debt to angel investment to private equity and venture capital, that basically focuses on the very important problem of providing access to finance, to long-term finance for small and medium enterprises. And this particular solution focuses on a distinct trading platform to trade the shares of SMEs that don't meet the listing requirements of the main exchange. So SME exchanges, as you can understand, are typically much smaller than the main exchange. And the World Federation of Exchanges finds that in many markets, the SME exchange has a market cap of less than 1% of that of the main exchange. So what is the rationale for an SME exchange? From the perspective of the SME, other than raising capital, they are able to diversify their investor base, increase credibility and brand visibility, align with the SME exchange's own brand, improve transparency and financial reporting, and therefore gain credit worthiness and be able to access other sources of financing. From the exchange's perspective, an SME exchange helps drive the pipeline for listing on the main board because it allows the exchange to incubate smaller companies. And it also helps the exchange provide an exit opportunity for investors like private equity and venture capital funds, and allows the exchange to provide diversified investment opportunities for investors. From the investor perspective, of course, other than diversification of investments, they are able to invest in companies that may be backed by private equity and venture capital funds. The exchange allows price comparison between different types of SME investments, and there may be tax incentives. So the SME exchange usually has some distinct structural features, which basically start with a government national policy that forms like an umbrella policy on under which the SME exchange is formed. It's the policy on access to capital for small and medium enterprises. So the SME exchange is typically a separate board under the main market. It's not usually a separate legal entity, although it can be standalone. In terms of cost structure, it's often subsidized by the main board because it has very limited listings. And in terms of target SMEs, that can vary by market in terms of the size and sector that the SME exchange targets. So if you look at the key features for SMEs, it is the lower entry requirements that I mentioned earlier, lower entry requirements than the main exchange typically. There are disclosure and governance requirements, and there are fees associated with listing. And on the other side, for investors, there are eligibility rules around who can invest in such exchanges. The disclosure requirements are designed to incentivize and protect investors. And as I mentioned, there can be tax incentives. So in the middle here in that chart, what you see is that the authorized advisor, and that is a distinct feature of an SME exchange. The authorized advisor is a licensed intermediary that vets the SME, helps them meet the listing requirements, and basically provides a stamp of approval that can provide safety, comfort to investors. So these are licensed, regulated intermediaries by the exchange or the Capital Markets Authority, and they're sanctionable for non-performance. Okay, so what are the drivers and impediments for SME listing? So I'm actually going to focus on the drivers and then the SME's perception of cost, and we'll come back to challenges a little bit later. In terms of drivers, there has to be a sufficient pipeline of SMEs that require equity financing. The presence of private equity and venture capital funds that seek exits through the SME exchange is also important. And then licensed advisors that can actually vet the SMEs, as I mentioned. Allowing private placement as a first step to listing is also helpful. And then taxes incentives to investors, subsidization of costs for SMEs, and outreach and training for them. In terms of what the SME perceives to be the cost of listing, they perceive both direct and indirect costs. So with direct costs, other than preparing the prospectus and documentation and the payment of advisor fees, broker fees, legal fees, compliance fees, and listing fees, they also see indirect costs. They perceive reduced control of a company, perhaps. The increased visibility may also provide concerns about increased scrutiny of the company, the governance requirements, and time for compliance and investor relations may also be concerns that influence their decision to list. So the World Federation of Exchanges notes that there are over 45 global SME exchanges or alternate exchanges, but this is a very concentrated landscape because of the top 10 SME exchanges by market cap, 7 of them are in advanced economies. So what this graph is showing you here is a timeline for the launch of different SME exchanges across emerging markets. But on the extreme left, you have a reference point when the UK AIM SME exchange was launched in 1995. That's one of the most well-known exchanges. It currently has 837 listings. What you see in this graph is that on the African continent, South Africa and Botswana have the earliest history of SME exchanges, starting in 2003, 2004, respectively. And then in 2013, immediately after the global financial crisis, you have SME exchanges that are set up in Ghana, in Nigeria, and in East Africa, in Kenya, Rwanda, Tanzania, Uganda. But in general, what you find is that in African SME exchanges, as across emerging markets and in a number of different SME exchanges, they've suffered from underdevelopment because of low listings and low liquidity. So now we come to what are the key challenges that are faced by SME exchanges. So if you define success as the number of listings on an SME exchange, the capital raised, and the graduation rate from the SME exchange to the main market, then a lot of SME exchanges have had trouble and not been as successful as they would have desired. So the key issue is one, availability of pipeline, because despite the low listing requirements, the entry requirements, SMEs may still not be able and willing to comply with the requirements. Second, the secondary market on SME exchanges is typically much lower than that of the main market, posing an exit risk basically for investors and distracting them. Third, there is an information gap around SMEs because research analysts don't typically want to cover SMEs because it's not as commercially viable. And so there's little research available to give comfort to investors. And lastly, another key challenge is sustainability, because in a lot of emerging markets, even the main exchange may be struggling, and the need to subsidize an SME exchange may pose more difficulty. So my last slide here is focused on the recent strategic efforts across the continent to revive SME access to long-term capital, which I think we might hear from some of our panelists. So you see that in Uganda, Tanzania, Kenya, Rwanda, the SME exchanges have basically launched capacity building programs to basically groom SMEs, make them more investment ready, including to be able to list on the exchange. And then you also see some reconfiguration, revamping of existing SME boards. So for example, Nigeria discontinued the alternative securities market, replaced it with the growth board in 2020. And Botswana has launched a new Shipiri SME board with less burdensome entry requirements than the previous venture capital market. So with that, I'm going to stop. Thanks very much, and looking forward to hearing from the other panelists.
Thank you, Shanti. Thank you very much. Mr. Tapelo Cheole, you are welcome now to share your slides and your insights. Thank you very much.
Thank you, everyone, and good afternoon, good evening, or good morning across all the continent. I'm just going to be looking mainly on the issue of really how our SMEs, our business as exchanges, and I'm basically going to be looking at about 4 or 5 aspects: why SME development, financing SME development, especially at the BSE as a case study, and also why SMEs are important in terms of to achieve financial inclusion, especially in Africa, where this is also a problem, and also just some the way we use the SME in the BSE to build a future pipeline for listings. Let me try to get to the third slide. I can't move my slide. Okay. Yeah. Okay. No, thank you. Yeah, I think the third part of my slides look at why SME development. I think just go to the third slide. Yeah, that one. Thank you. You know, when you look at the study that have been done by World Bank, I think I've attached the link in there. You realize that majority of the economies, SME plays a very important role, especially in African economies where, you know, we have very small in manufacturing. We have very small enterprises. They play a very important role in terms of employment, in terms of production, and also in terms of subsistence, where majority of the people just produce to feed themselves. And therefore, you realize that even generally, I think worldwide, about 90% or more than 50% of employment worldwide is because of SMEs. And therefore, the formal contribution to national GDP in majority of emerging market economies is about 40% to GDP, which I think is very significant because it really shows the value of the SME to the economy. But one of the challenges of SME is that they're less likely to obtain bank loans than large firms, mainly because of their governance structures and also the way they're actually formalized. And therefore, you can't really have a clearer risk profile that is needed by the bank to actually extend a loan to them. And therefore, what we are saying as stock exchanges is that this is an area for us to develop as stock exchanges, so that we access the much needed finance to some of these SMEs. And one of the areas which is a very good development is that, you know, the spec model in some of the instances is that, you know, you can group a number of SMEs together and then just obtain a certain shareholding on it, and then you come and list as a group entity, that have got several investments in most SMEs. So I think it's one way to be innovative as capital markets participants, not necessarily stock exchanges, but intermediaries who can actually bring instruments to the market who have consolidated a number of shares of SMEs. I think if you have to move into the next slide, especially the one that deals with financial inclusion. I think the financial inclusion is very important, especially for policymakers, and therefore I think most of the SMEs are actually outside the formal economy. It's sort of classified in most instances as informal economy, and therefore I think as a measure to really include them in the economy, we have to make it our business as financial market practitioners to actually engage SMEs and also make sure that we liaise with them to include them in our economic activities. Because I know majority of the countries, especially in Africa, they tend to regard SMEs as the most informal sector. But I think if we are to close the gap in terms of financial inclusion in emerging and developing economies, we actually need to come closer to the SMEs, to try to help them to improve their governance, to help them sort of avail information to them to do that. Because some of the companies, you realize that they operate as only basically one man's show, with no bookkeeping or whatever, which they're supposed to do. But I think if we can put on the basics in terms of SMEs, I think they can contribute much more to the general economic growth. And then ultimately, I think they can also mature as companies that are able to play a major role in the economies of the world. Because I don't think most of them really want to remain SMEs for life. It's only that, you know, some of them don't know the opportunities that might be there that they can take advantage of to grow themselves as a companies. But if you look at the dominancy, which is my next slide, the dominancy of the sector in Africa. If you look at the study done by the Center for Strategic and International Studies, you realize that, you know, the SMEs are the backbone of the economy. They account for about 50% of the jobs, and in Africa, in some instances, is up to 80% of the jobs. And this represent a very important economic driver. That is why, I mean, this topic is befitting that, you know, SMEs should be our business, either as stock exchange or as participants in the capital markets or in the economy. Because in sub-Saharan Africa alone, you realize that there are about 44 million micro medium enterprises. I mean, this is a very large number, and most of it, I think, it remains very much untapped, and they require funding. And, you know, if we are able to explore the opportunities and the potential of these SMEs, we can be able to create different platforms across the ecosystem of financial markets, either as angel investors or either as stock exchange or either as SME exchanges, to avail the much needed capital to them. Because immediately we avail the much needed capital to them, they will now be able to play a more meaningful role in the economy. At the PSE, how we have nurtured the SME development. We started off initially with the venture capital board, which was actually a startup board. But later on, we realized that, you know, it was slow to kick in. But of course, we were successful in such a sense that some of the companies managed to migrate from the venture board to ultimately migrate to the main board, which is the very same theory that I'm saying that, you know, when we can avail the platform and the opportunities to SME, they can be able to grow as companies. And then in 2019, what we decided to do is that we decided to introduce a much more less board called the CPD mentorship, the CPD SME board. And what we do is that we first call for applications to participate in the mentorship program. And then after that, all the firms apply. They tell us what they do. They tell us their turnover. They tell us their sizes. They tell us in what industry they are. And therefore, we decided to take about 20 in 2019. And also because of COVID restrictions, we only allowed 13 in 2021. 2020, we didn't take any. And what we do is that we call some asset managers, we call some regulators, we call some corporate finance experts who put together this group of SMEs who have been selected from a large pool. Normally, we have more than 100 applications, and then we will take the ones that we think that at a certain stage. And then we even call some corporate governance experts. And then we'll go on with the owners and or finance directors of these companies over a period of 3 months. And then after a period of 3 months, holding them through the process, not necessarily to drive them to the exchange, but to try to make them into proper corporate entities that can know that they need to have all the other documents. And then ultimately, after 3 months, we now continue with hand-holding after their graduation into the program. And you realize that some of the companies, out of the 20 companies that we had in 2019, I think about 4 or 5 have been working so hard in the past 2 years to try to structure themselves, putting together proper corporate boards, putting together succession plans, and putting together some level of accounting and growth strategies in order to ultimately become companies that can entice even the investors. So we are looking at about 4 or so listings from the 2019 one. But of course, I think COVID just mixed up everything, and therefore things tended to be slow. But if you look at the initiative, you realize that we try to, as much as possible, to look across the industries. We invite asset managers to give them presentation to say, as a fund manager, for me to invest to in your company, this is the basic minimum requirements that I need as an asset manager. So this interaction, which is done by industry participants to SMEs, is on voluntary basis. As the stock exchange, we only provide the platform, but all the expertise is from the corporate lawyers, from the corporate financiers, and also from some of the investors. And I think it's a way to build a pipeline for us as an exchange, no matter how long it takes. But ultimately, I think we now have a framework that we can now monitor these companies. We have what we call the listings journey. We plot these companies at the time we onboard them. And then when one company is on the progress of maybe corporatizing themselves, putting together some board members, and then also trying to obtain valuation, we move them to the other stage so that we ultimately sort of look at them. But what we do is that we look at the requirements are very basic in terms of I think you can go to the next slide in terms of what we need from these companies. Normally, that slide deals in terms of the TPD mentorship. What is it that we do to them? Normally, in terms of the requirements are very basic for us because, you know, majority of these companies are just too small, of course, especially for institutional investors. But when you look at the growth strategy, when we impact knowledge to these companies, we are able to realize that, I mean, over a period of about 2 to 3 years or 5 years, some of these companies actually will be ready for institutional investors. And it takes time, but their contribution and their role to the economy makes us not to ignore them in anyhow, as either stock exchanges or as capital market participants. But of course, there are challenges in the ecosystem, especially in the industry. There are some other asset managers who ordinarily feel that, you know what, some of these companies will waste their time. They won't ordinarily want to be having meetings with the guys who they can invest in. But there are some who have taken it as a corporate responsibility to really to sort of participate in the whole mentorship program. I think I've covered majority of my slides. So I think in conclusion, we are saying SME financing should be supported, and therefore we stock exchanges across Africa have dedicated markets for SMEs, and those who don't have should generally introduce it. But I think this should also be coupled by asset managers who are willing to keep up or put some level of capital into these funds, because as stock exchanges we can create all these platforms, but ultimately when the asset managers are not brought on board to invest into this company, I don't think anything will actually move. And therefore I think asset managers, brokers, and government, and also developmental agencies should actually work together to try to create an ecosystem, because if we are exchanges and we don't build this pipeline, I mean, in future, it also means that if asset managers are not helping us to build the pipeline, they'll have nothing to invest on in any case. So it's sort of a tricky ecosystem. With that, I think, thank you very much. That's my few cents contribution.
Thank you very much. There were more than a few cents and very, very interesting. Now I would like to turn the microphone to Mr. Siddiqui to hear his insights, especially that he sits in the Northern African part of Africa, so northern side. So please, Mr. Siddiqui, go ahead and share your thoughts. Thank you.
Thank you very much, William, for giving me the floor. I have no presentation, but I will try to be clear in sharing my insights. First, I would like to talk about the mechanism available for African SMEs to obtain funding via capital markets. And then I'll go on to talk about the preconditions of financing as well as the challenges. As most people here are aware of, SMEs play a major role in most economies, particularly in emerging markets and developing countries. SMEs are also a source of innovation thanks to their agility and business focus. So they are the future big companies, provided that necessary conditions for their development are put in place. Accordingly, the development of SMEs is a high priority for many policymakers, financial institutions, and governments around the world. Economic benefits can only come about if small businesses survive and thrive. Unfortunately, the context in which SMEs operate are not always conducive to their growth and development. They face a certain number of challenges pertaining to factors such as regulatory frameworks, tax treatment, human capital qualifications, and more importantly, access to financing. In fact, access to external financing, which enables increased productivity and fuels development, is a key constraint to the growth of SMEs. Situations like the 2008 crisis or the actual COVID pandemics, along with their economic implications and prudential responses, made access to bank loans harder, especially for SMEs, which rely mainly on this financing source. Accordingly, developing and promoting alternative financing sources for SMEs is paramount to preserve their growth potential. Here comes the role of capital market to supplement the existing solutions and provide adapted financing for this category of companies. However, as you may know, SME structure and needs could be entirely different from blue chip companies. SMEs face specific issues that need to be considered when bringing them to the market, among which first a lack of knowledge about the full spectrum of market financing solutions. Second, a family style of management. This may provide some flexibility for decision making, but may also pose a threat to the soundness of the business model and the future prospects of the company. Third, a perceived burden of compliance with various market obligations such as governance and disclosure rules. So these issues are major source of reluctance for SMEs, preferring more traditional financing. However, as I said earlier, these traditional sources are becoming more scarce and difficult to access. As capital markets regulators and infrastructures, we are required to provide adapted frameworks that account for these constraints, simplify them without sacrificing the investor protections. This calls for a certain degree of innovation compared to the one-size-fits-all approach. For example, here in Morocco, in the few recent years, the capital market is the subject of deep reform, where easing market access for SMEs is a very important component. Accordingly, a specific framework was developed to fulfill this objective. First, the Casablanca exchange market architecture was changed. Indeed, a specific market called the alternative market was created for listing SME securities. When creating this market and thinking about its listing rules, we faced a certain difficulty in defining what is an SME. We adopted an inclusive approach to maximize the potential of this market in response to the needs of local companies. So we put in place a definition based on 3 criteria: the amount of sales, the balance sheet size, and the number of employees. So any company meeting only one of the 3 criteria can access this market. Listing rules on the alternative market provide for lighter requirements on SMEs, such as only 1-year financial track records versus 3 for other issuers, as well as smaller issue amounts. Once the market was created, we also differentiated other rules applicable to issuers so that alternative market issuers are subject to lighter information and governance rules to, of course, account for their abilities. Indeed, based on extensive discussion with market participants and other relevant stakeholders, we introduced lighter rules for SMEs, pertaining mainly to waivers from some prospectus information requirements, waivers from ongoing disclosure obligations, such as quarterly reports, deadlines adaptations, such as the publication of annual reports in the 5 months following the closing of the financial year, and the lighter governance requirements, such as a minimum of 1 independent board member that should chair the audit committee. In addition to the regulatory development, the authority and the stock exchange also focus on other areas such as capacity building and ecosystem engagement to create a virtuous dynamic for SME financing through the capital market. For example, the ELITE program developed by Casablanca Stock Exchange in partnership with the London Stock Exchange Group provides a unique opportunity to train SMEs and get them ready to access the market. Currently, I think more than 100 SMEs have followed this program. The authority is also leading an initiative, a very important initiative for a global offer dedicated to SMEs. Gathering relevant stakeholders, this offer will consist of 3 components. First, reduction of the market access cost for SMEs by considering a significant reduction in the fees of various parties involved in the process. Second, simplification of market access procedures. And third, capacity building through general and specific trainings. It is true that all these initiatives and mechanisms are expected to have a big impact on the capacity of SMEs to finance their growth through the capital market. However, as a regulator that is following the recent relevant trends, we see further development potential in areas such as fintech, for example. The emergence of fintech is indeed driving innovative financing alternatives for SMEs. For example, we have put in place a crowdfunding framework to unlock financing for small projects and enterprises that otherwise cannot go to the market. In addition, we are also working with the various stakeholders to structure securities instruments that are based on distributed ledger technologies, such as blockchain. And this kind of regulatory sandbox approach would allow us to experiment innovative solutions and practically examine their benefits and risk for all the involved parties before mainstreaming such practice on the market. So thank you once again to the organizer for this wonderful exchange opportunity, and to you all for your attention.
Thank you, Mr. Siddiqui. Very much appreciated. Now it's time to turn to Mr. Joffrey Odundu and to hear his insight. Can you please share with us your presentation? Thank you.
Thank you very much, William. And I know now the last speakers, I'll be fairly short on this. Can you see my presentation? Can you see my presentation?
Yes,
William?
we can. Please go ahead. Thank you.
Great. So just reflecting back on the earlier discussions, I think it's been mentioned very well, the role of the SMEs and the importance to the economy. And I would like to just further just assert to that, it is a very key segment of the economy, contributing almost 80% to the employment and also 80% to the GDP. And hence, it's very important that we actually do appreciate what they, how to help them come on board and really address some of the key challenges that they face. So my presentation will basically cover three things, just tell you about experiences in three key initiatives: the Booker program, the Unquoted Securities platform, and then the growth and enterprise market segment. I'll skip the first three slides because that just gives us an idea of who we are. So as I said earlier, SMEs are really what I would say are very, very strong institutions and have been playing a very big role. And I'll give an example of Kenya, where we've seen about 5.85 unlicensed and 1.56 licensed SMEs. And this is just an appreciation that this is a very key segment, constituting 98% of our businesses in Kenya and employing almost 80% of the population. Now, we did a survey just to cover out and see what are the key issues that affect SMEs and why are they normally sort of shy of markets. And one of the key things that came out was the whole knowledge area around listings. This is one area that we have focused on, and I think my colleague Tapelo spoke about the corporatization and the incubation and mentorship programs, and that's something that is coming out very, 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 very well as a key area that we need to address. Notwithstanding the other areas about especially loss of ownership, which ranks second in our survey, and an indicative that a lot of founders want to maintain control, and this continues being an impediment to them coming to the capital market. So we formed three key tailored solutions. What we're aiming to address here was the dearth in listings at the exchange. And we asked ourselves a few questions. What do we need to do to really let a lot of companies come to the exchange? How do we open that door? And so we developed a program. We call it Ibuka, which is a Swahili word in Kenya that means emerge, as a platform to allow SMEs to basically come and go through what you call a corporatization program. And on that board, on that program, we've got two boards, which is the incubation and acceleration. Incubation basically aims to address the concerns and challenges facing startups and really companies that don't have very formal structures. And Tapelo spoke about mentorships and getting consultants to sit with them. And that's the kind of team that we have. And on the acceleration board, these are companies that have got some form of corporate structure, are currently just doing proper accounts, records, etc., and just require certain advisory services to help them fundraise and help them now prepare for themselves as potential investment-ready companies. And so those are the two boards we have. The advantage of this program is that we are creating an avenue for companies to look at the capital markets as an alternative financing platform. They are now appreciating that this market is just not meant for the large cap companies or mid cap companies, but also for small cap companies. The ability to get advisory services. I can tell you, some of the companies that we onboarded were not even aware about the strength of their balance sheet. And when they were told the power of leverage that they have on the balance sheet, then they were actually very surprised. And some of them have actually opened renegotiations with the banks in order to get funding. We talked about visibility. This was a very important aspect for us. We wanted to show them how to build brand equity and hence help them also increase their business focus, and that was helpful. We also helped them build business sustainability, enhancing the issue around succession, broader corporatization, bringing in board the right skill set at the very top level. And this has actually delivered results in some companies because now they are really focused. As opposed to being a purely family-run business, they're now more of a corporate organization. Value discovery, as I said earlier, some of them did not know what they were sitting on in their balance sheet. They didn't know what their value was, and we've seen better value discovery for some of these companies. And business opportunities. We also created a platform that they were able to interact not only among themselves, but also in collaboration with some of the other international partners we have. For instance, we developed a program with Shenzhen Stock Exchange. They run a similar program called VNext, and our book and the VNext partnered in order to allow our current companies to do non-deal roadshows virtually. And this was also helpful in opening up that avenue for trading. This is a process, not too much. I think as Tapela said, and my colleagues, this is it's a very easy entry process. We basically scan you, screen you, and help you go through just some basic requirements to enable you on board. These are the companies we have, about 30 companies on board. Some are pretty sizable now and are ready to go for bigger fundraising. For instance, Rentco is the largest leasing company in Kenya, and out of just being a member of the Iboka program, they've now realized their value and are able now to engage even with larger investors and are looking at really come to the market and now more at a mid-cap platform. Now, the beauty about this is that we have done a proof of concept. One of our first companies emerged out of this particular program and was onboarded onto our growth and enterprise market segment. So that was really a good show. This was on Homeboys, which is an entertainment company, and they were able to now onboard the growth and enterprise market segment and should be doing a fundraising sometime next year. Now, what is the message here? What this proves is that SMEs can actually be able to take this journey, begin a listing journey, and emerge into proper companies that can actually be able to fundraise and even list. Now, the other platform that we have developed is something we call the Unquoted Securities Platform. Now, the companies that we have on the Iboka program, even as they prepare in the future to join the large market, we're able to stage them on what you call the Unquoted Securities Platform, which is an OTC market. At this point, you don't have to comply with the stringent listing rules. You're basically governed by guidance and admission policies that we run. The market is an OTC, so it's more bilateral. A lot of capital is raised through private placements. And so this is more of a staging platform where they're able to start getting investors on board, start doing what you call private placement and OTC trading of their shares. And yes, we're seeing some very good interest. We already have onboarded not an Iboka company, but an unlisted security, REIT security, which is currently trading on this platform. The solution is giving them time saving, giving liquidity. It allows for transfer of shares more flexibly and ability to raise capital. And this again is a demonstration. The company the picture you see there is the launch ceremony of REIT of a company called Acorn, who listed their REITs on this Unquoted Securities Platform. And this is just a demonstration that SME companies can actually come in and raise money and do some phenomenal things on it. And then finally, our growth and enterprise market segment, which is a dedicated platform for the SME market. And here we started this market in 2014. We now have 4 companies on it. It's been a very interesting journey, a lot of lessons learned. The whole area around companies starting to comply with listing obligations, reporting their results, annual results. Again, those are the challenges that we've seen these companies have faced. But this platform is, again, very ideal for companies that are looking to enter into the market, because a lot of the admission requirements or the listing requirements have been relaxed. For instance, your minimum float is 15% of your issued share capital, no profitability records. All we want to see is that you have an ability to trade for 1 year, and we have got tax incentives. Now, this platform, companies in this platform pay tax at a rate of 5% below the normal corporate tax rate, which is a good way for them to come through. Now, we just wanted to share with you a final story here about one of our second largest companies on the exchange, and this company is called Equity Bank. Now, they started off as a small company, listing in 2006 at a price of 90 shillings, did subsequent corporate actions, bonuses, splits, and continuous growth. But they have used the market effectively. And today, they've been able to raise money, expand themselves, become a very strong regional bank out of beginning a listing journey as a small and medium-sized enterprise. Now, this is just a demonstration that it takes a belief, it takes aspiration in order for you to achieve this sort of goal. And I believe the exchanges provide that avenue for you in order to drive the growth and realization of that aspiration. So this company has grown today. We're looking at a company that has seen shareholders' funds grow all the way to 94 billion shillings in Kenya. And we believe that SMEs have got a great story. They're the future of these economies in Africa. And hence, we want to play our role as public markets to help them achieve that. So thank you very much, William, and I'll hand it back to you. Thank you.
Thank you very much. I have a quick question for Shanti. Don't you think that SMEs in Africa are too small for exchanges? And you have less than a minute, please. Quick answers.
Thanks. That's an interesting question. I don't know whether it would be difficult to say because national definitions of SMEs vary. And I think, as Mr. Siddiqui was saying, the definition used by the exchange itself varies. I think it's more an issue of capacity building rather than the size. And as Mr. Odundu just pointed out, I mean, Equity Bank started off as an SME. There's clearly a trajectory for SMEs to access the exchange. So I'm not sure size would be the key issue there.
We have another question for Mr. Tapelo. Do you think that we should open to institutional investors only, the investment in SMEs?
No, I think the thing is we just need to explain the risks involved in terms of investing in this sector. I mean, clearly, as exchanges or as the industry, we just need to be open to everyone as long as they're willing to take the risks.
Great. Thank you very much. Unfortunately, we ran over time. But again, I will sleep less ignorant tonight thanks to your insights. Thank you very much. Pleasure to be on this esteemed panel. Till next time. Cheng, thank you. Bye-bye.
Thank you. Bye.
Thank you, William, and thank you to all our panelists for your interesting contribution to this panel. So in a few minutes, we'll be moving to a presentation by Mr. Ahmed Roshdi, Risk Management and Sustainability Manager at the Egyptian Exchange. So Mr. Roshdi will officially launch the ASEA Sustainability Working Group reports. Thank you.
Thank you. Yeah, come in. Come on in.
Entered electronic exchanges more than 40 years ago. What most people don't know is that Nasdaq is a technology company by its core. Today we provide technology to more than 250 clients in more than 50 countries across all types of markets in the world.
The partnership between SGX and Nasdaq is more than a decade now. We are a multi-asset exchange. Our business is vertically integrated and we have an international presence. Technology is no longer separate from business. It's really about how we are reshaping business.
Tabcorp's vision is to be the trusted gambling entertainment company. Our wagering business,
second annual progress report, okay, the impact of COVID-19 on sustainability practices. But let me first thank the Casablanca Stock Exchange for hosting the annual conference and for their efforts. We have witnessed an extreme fruitful panels and dialogues and discussions also in the African capital markets. Okay, today we are launching the second report for the Sustainability Progress Report. But back in 2018, actually, when the ASEA Sustainability Working Group established to report on the status of sustainability performance and practices in the ASEA member and to promote and enhance ESG reporting and disclosure, and to communicate with top ESG index providers to develop an African ESG index, and to develop and to promote green finance product in cooperation with leading stakeholders, and also to define the impact investing with an acceptable specific definition for impact investing. In addition to coordinating with key stakeholders of sustainability like the United Nations SSE and the WFE Sustainability Working Group. We launched the African Capital Market Sustainability Roadmap, consists of only 4 pillars, okay? The internal impact assessment, the reporting on sustainability, markets and product as a third pillar, and the fourth pillar was market education. But given the COVID-19 today, actually, the COVID-19 and business continuity plan in capital markets is considered the new pillar for good sustainability practice. This is why our progress report for 2020 is about the impact of COVID-19 on sustainability practice. The report actually aims to identify current development and advancement in sustainability, opportunities and the challenges among ASEA members, in addition to the impact of COVID-19, as I mentioned before. The report is based on an annual sustainability progress questionnaire, which is an online questionnaire, consists of 58 questions divided into 6 pillars. Unfortunately, the report witnesses a low response rate this year. It was like 64% compared to 95% in 2019. For the impact of COVID-19 on sustainability roadmap, we have main 4 topics. The first is investor demand for specific disclosure. Second is if exchanges or regulator required a specific disclosure on the impact of COVID-19. And then the online capacity building to listed company during the pandemic. And finally, if the COVID-19 affected the sustainability initiative and the practices in the ASEA member exchange. For the first topic, the demand, specifically the investor demand for specific disclosure on the impact of COVID-19, we find that 28% of member exchange witnessed an investor demand for specific information. Actually, 28% of total number of ASEA member, but it represents like 43% of the all respond. Okay. And regarding the specific disclosure on the impact of COVID-19, we find that 20% of the exchanges and regulator required a specific disclosure on the impact of COVID-19 on the listed companies, actually these 5 exchanges. In addition to the online capacity building, we find that 5 exchanges representing about 20% of the members provided online capacity building programs to listed company during the pandemic on the sustainability reporting. The impact of COVID-19 on sustainability initiatives and practices in exchange, our results show that 28% of the ASEA members, okay, have been affected, obviously, with the pandemic, on the initiative and sustainability practices. For first pillar definition, the internal impact assessment, actually we have three main topics: the definition of responsibility and oversight, commitment and membership, sustainability, evolution, and KPIs of sustainability. For the sustainability committee, we find that 20% of member have a sustainability committee. Actually, 5% out of 25. But given the non-response rate, it affected our results, okay, heavily, because like in 2018, we have no response, zero response on this question. For the commitment and membership, results show that 11 exchanges are member in the United Nations SSE, and 6 exchanges are member in the WFE Sustainability Working Group. For the sustainability key performance indicator, the question was, does your exchange define your key performance indicator for sustainability? We find that out of the surveyed exchange, 7 exchanges, around 28% have defined sustainability key performance indicator. Regarding the second pillar, which is reporting on sustainability, we have 2 topics: reporting by exchanges itself and model guidance on ESG reporting for listed companies. For the reporting by exchange, we find that 5 exchanges publish an independent sustainability report, in addition to 8 exchange report on the sustainability within the annual report. And for the guidance on ESG, okay, we find that results show 7 exchange out of 25 member exchange provide written guidance on ESG reporting. In addition to 5 exchange actually are planning to offer a written guidance on ESG reporting too. And in addition to ESG reporting, we have a question regarding adoption of ESG reporting requirement in the listing rule. We find that 24% of the surveyed exchange stated that their exchange include ESG reporting requirement in their listing rules and regulation. For the third pillar, market and products, we have 2 main topics: introducing sustainability entities and promoting green finance products. Regarding the sustainability entities, we found that only 6 African exchanges have sustainability-related entities: the Johannesburg Stock Exchange, the Egyptian Exchange, Casablanca, Cape Verde Stock Exchange, and Nigerian Exchange Limited. For promoting the green finance product, our results show that 10 exchanges, almost 40%, support the adoption of green labeled products, while 5 exchanges do not support the adoption of green labeled products. The final pillar is market education and gender equality. We have 2 main topics: commitment to market education and capacity building on sustainability, and women empowerment and gender equality practices in the capital markets. The commitment to market education on sustainability and capacity building, we have found that 14 member exchange out of 25 surveyed exchange are engaged in sustainability dialogue with their market stakeholders, including listed company, investor, regulators, okay, and extra. In addition to providing training on the importance of sustainability, we have found that 36% of the surveyed exchange, 9 exchange actually, offer training on the importance of sustainability for listed companies. And most of these trainings actually was done, let's say, online as a part of online capacity building during the pandemic. The women empowerment and gender equality, okay. Our results show that 13 exchanges participated in ringing the bell for gender equality among the SAA member in 2020, and that we have 3 exchanges as a member of signatory of the United Nations Women Empowerment Principles, the WIPs. Okay. Finally, I would like to thank all the SWG members and thank you all.
Thank you very much, Mr. Rosdi, for sharing with us your findings on the ASEA Sustainability Working Group report. So last but not least, we will now move to the last panel of the conference, which will tackle the topic of impact investing. Thank you.
Thank you.
Very good day to everybody joining us on the line today. It's such a pleasure to be here with you. My name is Shamila. I'm the Chief Sustainability Officer of the Johannesburg Stock Exchange down at the southern tip of the continent. I have with me today an esteemed panel who I am very much looking forward to sharing a little bit of time with today as we unpack the important and growing topic of impact investing. So a slightly provocative title about who is afraid of impact investing. And our panel today, I think, is well qualified in being able to give us some insights on that from varying perspectives, or from coming from an investment perspective, from a little bit of standards and a regulatory perspective, and the different ways in which that ties up. And hopefully we'll also cover a little bit about the relevance to exchanges and to markets. Now, if we look globally at the challenges in relation to sustainable development, I think that we can attest to that we come from a continent where many of these are probably as evident as they are likely to be anywhere else in the world. We see huge masses of inequality, we see environmental concerns, and of course we see governance concerns as well. And when we consider this, and there is also the flip side, which is the opportunity to reallocate capital in a meaningful way and to make that capital work to build the future that we want, rather just sitting with the status quo and accepting a future that we're going to get if we don't make a more concerted effort. When we look at impact investing and its broader definition about the application of looking at environmental and social impact in a way that is alongside financial returns in the broader investment mandate. And with that, I want to quickly introduce our panelists joining us today. We have from the IFC, the International Finance Corporation, of course, a member of the World Bank Group. We have the Chief Thought Leadership Officer. What an interesting title. Neil Gregory, welcome to you, and thanks for joining us today. Neil is from the Economics and Private Sector Development arm of the IFC. We also have with us Rashid El Ashab, who is the Deputy General Manager of CDG Capital Gestion. Please forgive me if my pronunciation is not 100% today. We also have Karim El-Hnot who's the Deputy Head of Investment Bank at Societe Generale, and Corley Leroux, also joining us from South Africa, who is a board member of the GRI and an independent specialist consultant in sustainability, and of course also has had a history working with the Johannesburg Stock Exchange. So it's my absolute pleasure to welcome our panelists today and take us through this conversation, which hopefully takes us for, even if you don't understand what impact investing is, will take you all the way the spectrum to that, to how it can actually play out in investments. So I want to start our conversation today with you, Neil. The IFC has a long-standing history in sustainability, having been the home for many of the leading frameworks that we see in investment, leading many of the investments themselves via the different funds that the IFC has. Can you help us a little bit today with looking at the difference between ESG and impact investing? When we talk about sustainability, it's often used kind of interchangeable with this broader ESG term. And that has largely been what's taken root. When we talk about sustainability, people talk about ESG. But now we have impact investing coming along. When we consider the spectrum, if we look at the principles for responsible investment definition, there's a spectrum, right, in responsible investment, and impact investment sits on that spectrum at one end. How do you see this? Would that be a fair way of looking at it in the broader investment space or the responsible investment space? And what, in your mind, are the key differences between what we've traditionally considered as ESG and then now impact investing?
Great, thank you, Shamila, and good to...
Neil, we can't hear you.
Sorry, Shamila. Thank you for everybody for the opportunity to talk on this subject today, and thanks for the question, Shamila. I think that within the broad topic of sustainability, we can see that there's two ways to think about it. One is the effect that environmental and social developments may have on your business, and as an investor, on the performance of your investor. And that is what we call ESG risk, environmental, sustainable and governance risk. And there's been a greater appreciation, I think, by investors that those risks can quickly turn into financial risks, either in the short term or the long term. We've seen it during the pandemic. We've seen it with the increasing impact from climate change. And so
it's now becoming increasingly mainstream that investors consider ESG risks alongside other risks for the financial performance of their portfolio. For example, there's now over $100 trillion of assets managed in alignment with the UN principles of responsible investment. So that's the first aspect, is how environmental and social developments can impact your business or your portfolio. But it also goes the other way. How does your business or your investment affect the broader environment and broader society? And it's in that direction of travel that impact investing is focused. So it may look at the same issues. It may look at climate change. It may look at poverty and inequality. It may look at access to healthcare and education. But it comes to that from a different perspective, a perspective of not what does this mean for my investment, but what does my investment mean for making a difference and improving these environmental and social dimensions of the world we live in. And this really, I think, picked up momentum after 2015, when the world came together in Addis Ababa and agreed the Sustainable Development Goals. And 2015, of course, was the same year of COP25, when the world set ambitious goals to keep global warming within 1.5 degrees. And so I think that really brought to the attention of many investors the need to look at their investment portfolios and to start to understand how their investments could make a contribution to achieving those challenging global goals. And so we've seen an increase in interest in impact investing across the spectrum. It used to be a small niche, maybe of interest to philanthropies and foundations and less commercial investors. Now you see a wide range of investors having impact assets as part of their portfolios. Doesn't necessarily mean it's all of their portfolio, but pension funds, insurance companies, sovereign wealth funds, family offices, retail investors, all of those categories are showing increasing interest in having impact with their portfolios. And as a result, the financial services industry has responded, so that whereas 10 years ago, you would have had to go into a specialist fund manager or DFI like IFC to find opportunities to invest for impact, now all the mainstream asset managers have developed impact funds and products and are building up their capacity to assess impact and to manage investments for impact. So it's still a small part of the market. We think it's about $2.3 trillion today, but it's a rapidly growing part of the market. And interestingly, about 20% of the market today is investing in Africa. It's not very much, but it's a significantly higher weighting than you see in financial markets generally. And I think this reflects the fact that when you put an impact objective in your investment strategy alongside a financial return objective, it leads you to look in different places for investment, and that can lead you to put a bigger weighting on Africa than you otherwise might in your portfolio. I think you're muted, Shamila.
Of course, I had to make the mistake today. Thank you, Neil. So Neil, the question I think on many people's minds, of course, is that can impact and ESG investors earn reasonable financial returns in line with traditional investors? And, you know, could you share with us a little bit about the financial performance on impact funds with a bit more granularity? I think you shared some really rich statistics with us already. So if you have some insights on those, please.
Mm-hmm. So I think the people start from this question with two very valid perspectives. One is that if you're introducing another objective into your investment portfolio, isn't that limiting your investment opportunities? And so doesn't that have to reduce your potential returns? And the second perspective, I think, is that people understand that in the early days of impact investing, a lot of it was focused on very small stage social enterprises and startups, which were highly risky. And so it's not surprising that the returns were lower. But actually, I think today, the opportunity looks rather different. On the first point about asset selection, Well, that might be the case in public markets, but in private markets, which is where most impact investing happens, private equity and private debt, it's not just about balancing a portfolio and selecting from a range of opportunities in the market. It's much more about going out and looking for opportunities. And private equity and private debt traditionally is focused on a fairly narrow range of sectors and opportunities. This motivation and this drive for impact is actually driving investors to look in new places for investment opportunities, and often they're very attractive. And we'll take an example of Leapfrog, one of the big impact firms which operates in Africa and Asia, which looked at the big service gaps in financial services and health services and pharmacies and things like that. And they've made a very profitable investment portfolio out of investing in these segments of the market where there's huge growing consumer demand, particularly in Africa, and where there was really a gap in the market in these segments were underserved. And mainstream investors weren't looking at it, but when somebody came with an impact lens and was interested in closing access to finance gaps and closing healthcare gaps, then that led them to look for investments which turned out to be very profitable. The other thing which has changed the calculus is that you no longer have to just focus on early stage high risk investments. Increasingly, there are larger firms and more growth stage companies which you can invest in, which will deliver very measurable impact. And that's the space that IOC has always worked in. And we've found great success in Africa and other regions in investing in growth stage private equity and private debt. And when we look at our experience over a 40-year period, we find that our equity portfolio actually outperformed the equity market benchmark by about 15 basis points. Now, if you looked at any shorter, say 5-year time period, that wouldn't always have been the case, because you have to be a patient investor to invest for impact. You have to be willing to invest in markets which may still be nascent and early stage. You have to be willing to invest in countries which maybe aren't always as stable. But if you're willing to be a patient investor and take a long-term perspective like we do at IFC, we think that over a longer time period, you can earn just as good returns while investing for impact as you could just as a financial investor.
Thank you, Neil. So I think there already, I think you're helping us in really starting to see the clarity with which if this is done correctly and dispelling some of the myths, right? It's not just an early stage kind of a play. You're looking at growth stage and you're looking at that of private equity, private debt as well. I think very interesting to say where your experience has been as 50% sort of outperformance. And so if you go looking with that intent, I think that's dispelling some of the myths, right? That there actually there's good value to be found in these investments if you apply your mind correctly and you understand the market and what those things are looking for. Because often we talk about impact, we're talking about investments in healthcare, in education and things like that, that on the face of it don't look like it's something you want to be involved in, particularly if those services are catering to kind of lower income or previously marginalized communities. Yet that tends to be where the biggest need is. And surely there's opportunity. So I think thank you for demonstrating to us the flip side of this, which clearly is the opportunity alongside the financial opportunity, just opportunity to impact the SDGs and those things with the financial opportunity. So that helps us set the stage, and I think already create quite a positive impact on our intent around this. Rashid, let me move to you for a second now. So you have been working in the Moroccan market. Please, can you share with us some of the insights from Morocco on the opportunities and the demand? So looking at the demand and the supply side of the equation, the way you've seen it in the market, where you're operating on the ground with very particular projects, if you could share that with us. And then perhaps even some key lessons from CBG as you've operated now as a practitioner in the space.
Thank you, Shamila. I think that the question of the panel is very important. Instead of asking the same question, who is afraid of impact investing, I would maybe rather suggest another question. And the question is, who is willing to take the risk of a green swan? As you know, the black swan refers to the even that are extremely rare, lying outside normal expectation. The green swan refers to the extreme impact of highly probable climate crisis. Highly probable if we don't start acting properly and if we don't adopt immediately impact investing. So indeed, unlike the black swan, I think that the onset of the climate crisis could be seen before the event. And I think that everyone can remember the time when during the recent pandemic, I think that you saw what happened, and we are not away from another disaster that could emerge from climate change, social disparity, viruses, another disaster. But the human being, I think, still have a short memory. I think that if there is one lesson before talking about Moroccan opportunities, if there is one lesson to take from the COVID crisis, I think is one. You see that the world now is changing from an economy of return to an economy of resilience, and you know many companies now tend to change their from their business model from a relocation business model in order to reduce costs to bring activity back home. And this could lead maybe to the question of profitability, which will be taken, should be, in my opinion, taken with relativity, because if we take maybe into account the cost of disaster, we need to change the way that we are calculating the real return. And so we need to have a long-term view to better to better acknowledge where we will be facing in the future. This is it was between under bracket just to talk about who is afraid of impact investing. So let me share with you maybe some insights on why Morocco is a perfect ground to implement an economy of impact investing. As you know, maybe it's the same situation maybe in another African countries. We are facing a lot of challenges that create tremendous opportunities for impact investing. And I think that impact investing can enhance both education system, can also reduce unemployment, especially in rural region, lower inequality and disparity, and improve health sector, for example. I think that for many years, we have done a lot of strategy, successful strategy to consolidate both foundation of sustainable development, to promote energy transition, and to support clean technology. And I think that Morocco now provides several conditions which are favorable to the creation of a viable market of impact investing. And here I'm referring to a stable emerging economy with well-established institution and demand for an innovative approach to solving social issues, and also a government that is eager to tackle social problem. We can also talk about the great potential to act as a testing ground to build market-based solution and deploy them in the region. Let me give you some concrete example. After COVID, the Moroccan and with the economic stimulus program, the Moroccan government had adopted an important portfolio incentive aimed at encouraging private investment for public-private partnership in several sectors. I'm talking about energy sector, infrastructure, health, etc. The experience of the green investment in solar energy and the key role of the Moroccan Agency for Solar Energy in enabling country to attract private impact investment for its first large concentrated solar power installation. There is also a tremendous potential for microfinance sector, such as the one who is targeting the rural cooperative, establishing innovative ways to attract external gross capital in the form of debt or equity. I think that will become a very interesting opportunity for the future and for who is interested in impact investing in this region. I can also talk about the development finance institutions that have played the main role in impact investing, without forgetting the large group of the Moroccan community around the world that invest in their home country, and they could play an additional important role in facilitating the emergence of an impact investing market in Morocco. We can also talk about the role of authorities, the commitment of financial authorities that help to achieve these goals. For example, I can talk about the central banks who has made the commitment on the sideline of the conference of parties, the COP26, to carry out in the coming years a set of action to accelerate the greening of the financial system. And here I'm talking about supporting the development of green credit and financial products by the banking ecosystem and strengthening sustainable investment practice. We can also talk about the Moroccan Capital Market Authority, who developed and issued a green bond guideline for issuers and investors, and later extended the guideline to cover both social and sustainable bond. And recently, I think he signed an agreement with IFC that help companies enhance their reporting on environment, social and governance practice with the aim, with the only aim to better informing the markets about the performance and extra financial risk of issuers. So as an ecosystem, I think that we have a lot of our better ingredients maybe to develop the impact investment. I'm gonna talk maybe about CDG as a representative of CDG. As you know, CDG is the leading institutional investor in Morocco in terms of debt and equity, and so sustainable development is a part of our DNA. We intend throughout the years to contribute to the country's development efforts using all of our expertise, our financial resources, also our ability to attract investors. For example, I can a lot of example in terms of projects, and then maybe I'm just. It will just talks about one of the most compelling projects, which is the Znata Eco-City, that was conceived on the basis of three fundamental pillars of sustainable development, which is the environment, social, and economic, with a real impact on population. Another product that has or will have an impact also, I'm talking about water, access to water, energy, etc. I think that throughout the process of defining our CSR policies, CDG Capital, which is the investment banking of CDG, have integrated ISO 26000 standard as reference framework, and have taken care to question of contribution to the achievement of the 17 nation goals of sustainable development. We're also active member of IGFC, and we work together with members to implement the sustainable development goals and the Paris climate change agreement agenda. And so I think that we position ourselves as a privileged partner of all sectors, public spheres, whether companies, institutions, authorities, or government body, but with different business units, private equity, asset management. We play an important role to finance the economy, and we try to put ESG criteria in general throughout our process. This is the beginning. I think that we will put it through our whole investment process in different business units. I think that I give some small idea about Moroccan opportunities. Let me just conclude. I think that we have the willingness of government to develop the economy and the involvement of the authorities. We have also opportunities in the public, private institution, and civil society. We can also count on our good partnership with international institutions. I think that we have the necessary ingredient to develop a real economy of impact investing, and maybe the conference and will allow us to have more global vision and to take advantage of what is being done elsewhere, and highlight maybe the most successful experience in Equatorial regions.
Thank you so much for that, Rashid. I think so many useful points that you brought in there, but I couldn't help but notice in the Moroccan environment, there's a role of critical things there. The first one was the involvement of the government in the regulatory context that has helped to create the enabling environment. So you saw that both on the policy side, the regulatory side, the development of the green bond guidelines at the national level, all of these things, I think, played together to create really a good enabling environment for what we've seen now has been some of the success factors in Morocco. I think added to that also, if I listen to your experience of CDG, is how the private sector has actually played its part. almost as a kind of a public-private partnership approach, so to speak, to be able to say, how do we bring together the best of both to enable this vision that has been clearly now set out for the country at the national level. So some from there, I think some critical elements coming out from a different perspective, right, on how one can create that enabling environment, but at the same time deal with very particular issues in your country. You mentioned up front, unemployment. You mentioned some of those issues that, the need to bring more people into the economy. And thanks for giving us the demonstration of how that that could be actually quite useful. I see there are some questions coming in on the chat. I'm going to hold on questions for a moment until we get through some of the first interventions of the panelists, but great to see. Please keep them coming, audience. Lovely to have that. We're going to change gear a little bit now, and I want to turn to you, Corley. So we're changing a little bit, but actually it's all part and parcel of this broader creating of an enabling environment conversation. So Corley, it's not always clear how impact investing relates back to listed companies, to the context of exchanges. I mean, we're here in an ASEA conference, but there has now been a few years of history of sustainability reporting. And ideally, that reporting should be preceded by sustainability and integrated thinking. And we've seen now in Rashid and even in Neil's intervention, some of those elements of how integrated thinking can help. Please help us understand the link to corporate reporting and what role these sustainability standards are playing at an enterprise level. We're in there's been a plethora of these, so much has been said about the alphabet soup of frameworks and things like that. And we see now major global moves, right, in the bringing together some of these standards and things like that. What is the link to corporate reporting, and what role are these playing at an enterprise level in a broader space that we can actually make the linkage to impact investing?
Thank you, Shamila, and thank you so much for the opportunity to share this platform with everybody today. I think, the important element here that we're talking about is transparency, and transparency for the sake of decision usefulness. So enabling investors to have the information that they need to be able to make informed investment decisions. And I think whether you're talking about ESG risk management, or whether you're talking about investing into a publicly listed company or into an impact investment fund, the need of transparency is a common one. And I mean, you've referred to the alphabet soup of standards and things. Indeed, that has focused mainly on the at enterprise level. So for organizations to reflect on that inward-looking approach of, how does the ESG risk that Neil was also talking about impact the enterprise itself, but also for them to report on how they are impacting on the environment and society around them. I mean, as a common example, a mining company would be reflecting on how their mining activities have a negative impact on the environment or the society around them. And so sustainability standards, as they're already coming through in the questions as well, have mainly tried to ensure that companies are able to reflect on those risks and their responses on them. And I think what we're seeing now in the 20 years of evolution, that we've seen various kind of frameworks and approaches with different different entry points and different kind of target audiences starting to converge to a place that says we need decision useful information for investors and other stakeholders to be able to see what the impact is. So that to me has been a really interesting shift in the reporting environment, is that shift to focus on impact of activities and of investments. And I think much as the sustainability standards and the sustainability reporting standards are essentially fit for purpose for enterprises, we don't necessarily see those same kinds of standards yet in the impact investing environment. But I think we're going to be seeing a lot more need and a lot more demand for expanded information, so that investors into the impact investing environment are able to discern whether the impacts that are being held out to them as being the purposes of these vehicles are actually being achieved. Similar to when you're investing into an enterprise listed on an exchange, you want to be able to see that the broad range of risks and opportunities are being managed and leveraged by the organization. And so I think there isn't a need to reinvent the wheel for the impact investing environment. I think a lot of expertise and knowledge and experience has gone into the development of these reporting standards, and so they could also be adjusted to be fit for purpose for the impact environment, to the extent that they are impact focused and can focus on outcomes of the activities.
Thank you, Corley. So that's very helpful for us to be able to try and make that linkage back, to this, where we've seen ESG and sustainability kind of broadly develop has been at this enterprise level and corporates and things like that. And yet sometimes this impact conversation seems to happen completely outside of that. And indeed, some of the criticisms of the ESG frameworks have been that they sort of kind of a do less harm approach, whereas impact might actually be, how can you actually do good? But thanks for helping us sketch kind of where in that spectrum these things are probably likely to come together and actually need to come together if we're going to move the dial on achieving the outcomes we're hoping for with with sustainable development. Can you quickly reflect for us on the latest developments that we're seeing happening globally? If you can give us a sort of a 2-minute view of what your thoughts are on that and where these things are coming together.
So there have been discussions for some years to try and converge many of the frameworks that exist, and it started a couple of years back with the 5 largest frameworks, including the GRI, SASB, the CDSB, the CDP, and so on, starting to have discussions around how do their frameworks overlap, how can they enable users of these frameworks to find convergence rather than having to comply with or apply various different kind of checklists. The latest developments that we've seen is the establishment by IFRS, the International Financial Reporting Standards Body, to create an international sustainability standards board alongside the Financial Standards Board. And the intention there is to create a set of standards that will be focusing on financially relevant sustainability information, with a specific aim at investors. So, that is a significant development to put financially related sustainability information at the same footing or on the same level as pure financial information. And I think in the impact environment, that kind of alignment is going to be extremely important as well. But beyond that, it's also in starting to incorporate integrated reporting into that fold through the merger of SASB and the International Integrated Reporting Council to create the Value Reporting Foundation. They will also be part and parcel of the IFRS work, and IFRS is also going to be incorporating the Climate Disclosure Standards Board. So that convergence is really happening, and it's happening fast. So, it's probably one of the biggest evolutions we've seen in this space in the last 2 decades. Not to lose sight then of the GRI, which is also still going to be playing a significant role in terms of that outward reporting, looking at outward impacts of an organization's activities on the environment and society. So while, we're not necessarily seeing the creation of a single standard, we're seeing convergence enabling kind of a single picture of where the different components of sustainability-related information can fit in and can be reported in a cogent manner for use by stakeholders and investors.
Thank you, Corley. I think that helps also just, it helps with a bit of clarity as to where these things fit in. Although, even listening to you, the plethora of acronyms is enough to make one's head spin. But we need to get to grips with it. We need to know where this is leading, and it's gonna matter a lot for the companies, particularly in our continent, that are directly impacted and affected by many of these challenges that we're seeking to deal with globally. Now, I'm going to add one more acronym to the mix when I turn now to to Karim. So Karim, you are a recent signatory, your organization is a recent signatory to the PRI. So here's it, one more acronym for the day, the Principles for Responsible Investment. Can you share with us a little bit about your journey and your experience? And I mean, I'm sure the key question that you were facing when you decided to sign up to the PRI is that, can these sustainability considerations, responsible investment, lower our return? So how did you approach that question? What did you find out? What were your conclusions on that? If you could share some of your insight, please. Karim? Okay, there you go.
Hello all. Thank you, Shamila. Being the last panelist of the last panel, I am. I think it should change actually that we are online and not in a physical event, because everyone will be packing and heading at the airport, right? Yeah, I mean, who's I would relate to the question, who's afraid of impact investing, and the question when we start thinking about the PRI was exactly the same. So when we start talking about the PRI within Sogei Capital Gestion, everyone was afraid, because we are afraid of things that we don't know. And as Neil said it, when you tell your manager, maybe you don't have exact same tools as everyone else, so basically said, well, maybe I'm not going to have the same returns. So that was a good question. Now, the way we see it and the way it makes sense to us is, as the PRI for us is more about managing risks than anything else. So I think that when we start taking ESG into our views, it's just about managing other risks than financial risk. I think that everyone know what a financial risk is in bonds, in equity. Now, what happens when you do invest in a very good bank, for example, but there is not enough investment in data, and the data gets stolen. So we have a problem. If you invest in a mining company, very good one, but it does not address the labor laws adequately, then you will have a problem down the road. So that's why we think that actually looking at ESG and PRI being part of it is really about making more thorough decisions and making better decisions down the road. And we're talking about medium long term. So that's the way we go with it, and that's the way it makes more sense, and we should not be afraid of it. And actually, it should. On the other hand, we think that it should provide better return to our investors.
Thank you so much for that. I think that has quickly answered many of the questions. So I think even though we have quite a few minutes left in hand, we're getting a clear picture of impact investing, and that it shouldn't be something one is afraid of. In fact, has a very useful role to play, and possibly in the near future, maybe even a more dominant one. So let me just stick with you for a minute there, please, Karim, and ask you a little bit about the fund. So you've recently launched a new fund, your Social Impact Fund, and that's aiming to help fund associations that can have significant impact on society. Could you share with us a little bit about this new fund, the structure of it, how it was designed, and a little bit about the experience if you've already made investments out of that fund?
Sure. Thank you. Well, we talked about something that can actually bring the financial markets and harness the power of the financial market and make impact on population. So we are in something between actually impact investing and philanthropy, because when you do invest in that fund, the fund is open to retail investor as well as corporate investor as well as institutional investors. What you do is actually take all the performance that's going to be built in on the fund, and so you're gonna not earn performance. All the performance is gonna go to a segregated account, and that account is gonna fund associations that are working on different fields, in social fields, like you name it, like in health, like in education, like in help, like in poverty, like so things like that. So basically, you put money in the fund, you're gonna get your capital pretty much, because it's a money market fund, and everything earns is going toward social impact. And I should add, and that's very important, that there is a selection, of course, of the project, and that selection is done by a board that is completely not within, Société Générale. So it's very independent, and we have people from business area, from the social field, from university, that's gonna choose that's gonna choose the association that's gonna get the funds based on the maximum impact on the population. So we are really into a pretty unique beast, if you will. It's impact investing, where it's something between impact and philanthropy, and really the basis of the thinking is how we can use all the tools to help people out there that are really needy of that help.
So, Karim, very helpful there. I think for me, the key takeaways from there, as much as you're saying it's different, is that it's innovation, right? And we can't solve the problems that we're facing now with the same mindset that created them. And I think the innovation around the way your fund is set up, the way you're using the money, or where you're investing, wherever there has been outperformance and things like that is critically important. The second feature I find very interesting there is the governance mechanisms you've set up. You've talked about having an independent board that is actually looking at that, and that you've also driven with intent. So for me, the three things there would be your innovation, the intent, and then of course the governance around that coming together to be what seems like a really, really powerful mix of things to further the agenda and to actually deliver on the intent of that fund. So very interesting to see that, and we're seeing that across the board in sustainable finance now, where the need to be innovative, to think differently, and to be brave enough to do it is critically important. So I think very useful insights there. We're just over the hour now, and we're into the Q&A time. So I'm going to pause with further questions for the panelists to address some of the questions coming in on the chat. And then after a few minutes, we're going to take some closing comments. So here are some comments coming through from the chat. I'm going to read them out. The first one is directed at Rashid. What types of frameworks and standards, and in brackets the person has TCFD, SASB, UN, SDG, there we go, our acronyms again, does CDG use in its investment process? So do you apply frameworks and standards, and if so, which ones are they? If you could give us some insight on that. You're on mute, Rashid.
I'm sorry.
Good, can hear you.
As I said before, CDG Capital is a member of IGFC, and IGFC is a group who is aligned with the United Nations SDG goals. But now I think CDG Capital also is a bank, and is under authority of a central bank and Moroccan EMMC, Moroccan Capital Authority, which and I talked about the central bank that signed a commitment on the COP26, and the central bank now is a member of a huge group in GFS, and this is a network of central bank that supervisor of greening the financial system. I think that we will use any framework coming from authority in order maybe to reinforce what we have already in the process investment.
Thank you. I'm going to move on quickly to the next question. This one, so I think this could be probably either Rashid, Karim, or Neil, in fact. Do you rely on internal or external assessments and sources to identify companies for your investments? So I'm happy if anybody puts their hands up to give a view on how you go about sourcing and identifying the companies for your investments, if you want to share with us. Happy to take more than one response, so please just unmute and give us some insight.
Maybe I can start on that, Shamila. So first, we have a large portfolio of impact investments, about an $80 billion portfolio. And so we source these from all over the world through a network of country offices, have many investment offices. In different countries, I think you have to be close to the markets and close to the opportunities to find them. That's as true in Africa as anywhere else. When you look at where a lot of the impact funds are located today, a lot of them are located in Europe and North America, and they don't have this good network to source opportunities in emerging markets. And so I think there is a great opportunity for local financial institutions, for local investment funds to connect to those global impact funds and source deals and co-invest with them, because I think that is a challenge that many impact funds find, that they can raise capital because there's a lot of interest in impact, but deploying the capital and finding the opportunities, particularly in smaller frontier markets, is quite challenging. So this, I think, is an area where it's important, I think, to work with local financial institutions and local fund managers in order to do the deal sourcing.
Sorry, I muted again. Any other insights? Thank you, Neil. So that was quite helpful from obviously an IFC perspective, where you're sitting at this high level and needing to have eyes and ears on the ground at the local level to be able to enable you to know what's going on. So the partnership model, I think, there seems to be the one that you're using in actually sourcing those. And of course, the local understanding, right? Local market knowledge, which it seems to be very relevant in this case. Rashid, Karim, any other insights you want to share on how you're sourcing and identifying targets for your investments?
Well,
Karim?
As an asset manager working on public equity, we don't really source. I mean, it's maybe the question is more toward impact investing than ESG. As I said, as a PRI, we need to have a framework for assessing every one of the components of our portfolio and get it get some kind of rating of the ESG. So we don't really source specific investments in our portfolio, but we do need to rate all of them and get rid of some of them if they don't make the cuts.
And I think, Karim, maybe there, if I understand the question correctly, what people are asking is that when you're performing that assessment, in the case that you've clearly articulated for us how you go about this with equities, do you develop your own framework, or do you possibly use the frameworks, assessment frameworks of external providers on coming up with that ESG view or rating?
I couldn't hear all the questions, Shamila. I'm sorry.
Oh, no problem. So my question was that when you're doing this assessment of companies to come up with an ESG rating, are you doing that based on your own sort of proprietary framework that you've put in place with criteria, or do you use external service provider type frameworks to be able to perform that assessment on the companies?
we are for now using our own assessment. I mean, someone asked a question about SASP, for example. So we start using SASP and Kira process, plus our own knowledge of what's going on within the company. And then again, we need to ask questions about ESG politics for each of our holdings. So we do it internally.
Okay. That's that. Thank you for that, Karim. Another question coming in. Do you think retail investors consider ESG, or is it more an institutional game? So anybody willing to take that question?
Shamila, let me jump in. I think, I mean, it varies from market to market, I guess, you know, depending on the extent of retail investment. I think kind of your structured ESG risk management has been more an institutional approach, and there's certainly been a lot more kind of exposure and pressure on large institutional investors to actually incorporate ESG into their investments, as we've seen through the work of the UNPRI. I do think, though, you know, we are seeing a return, you know, from retail investors to, you know, to investing with a conscience. And certainly, and I think that's again where the transparency in you know, in a usable fashion becomes very important. You know, rather than working with kind of complex valuations and things, being simple about the actual impact that's being achieved, I think is certainly something that that retail investors are increasingly asking for and finding attractive in making investment decisions, if that helps.
Thank you, Koli. And I think that's consistent. If I can just maybe bring in another possible proof point or a proxy for the interest of retail investors, is the increase we're seeing in exchange-traded funds and sustainability-focused or ESG-focused exchange-traded funds globally. So if we look at the number of these, the new ones that have been listed or those that at least have been labeled, and I know there are questions around labeling itself, right? Because there's an entire different debate developing around greenwashing or sustainability washing. But just on the face of it, those that are labeled as ESG ETFs are actually just growing exponentially globally. And I think in the broader ETF category globally, the actual section that is looking at ESG ETFs has been the biggest growth area. And typically, your investors in ETFs are actually your retail investors. So there's another possible linkage that is showing us proof that this is something of interest to retail investors. Of course, the other question then is that how big is that relative to the size of institutional investment in the market? And I think that's the other question. Neil, maybe I could ask you to weigh in there a little bit, if you possibly could, about what might be the interest of retail investors versus institutional investors in responsible investing broadly, if you have any insight at all.
So in the developed markets, particularly in the US and Europe, we've seen a big increase in investor interest in ESG investment products in public markets, ETFs, mutual funds. And you've also seen in some markets that retail investors have been buying green and social bonds where they're available. So I think the interest is there. And in the past couple of years, those strategies have also outperformed the wider market because they've tended to be overweight technology stocks and underweight extractive industries. And so, you know, this, I think, is reinforcing the investor interest. They first got interested because they wanted to have a sustainable portfolio, but they now see that it's also going to be a financially attractive strategy. So I think the retail interest is going to continue to be strong. And just on the question of labeling, I think this is very important, that for retail investors and institutional investors, that they have a clear understanding of which products are ESG products and which products are impact products. And you may choose to have both in your portfolio, and you can decide how much of each you want. But what is important, I think, is having clear labeling. One contribution to the labelling has been the operating principles for impact management, which are a market standard for what it means to be an impact fund, which are now used by about 150 DFIs and impact fund managers managing about $500 billion of capital. I think that has led to a sorting out amongst private equity and debt funds, a much clearer labelling of which ones are impact and which ones are ESG. I think in the public markets, you're going to see that kind of sorting out as well. Already in the European Union, the regulations there have led to some reclassification and labelling by asset managers of different funds in order to comply with the emerging EU labelling. I think you'll see similar developments in other markets going forward.
Thank you, Neil. Very helpful. And I think that whole question about seeing some of the labeling coming through and what the impact of that is going to be is very, very valuable, because, as much as we want to say we're putting our money into ESG, we want to know that that is credible and that is delivering something valuable at the end of the day. And who do we turn to be able to make sure that it's doing what it says it's going to do, or at least it's implying that it's going to do. So I know we're coming up for 5 minutes to the end, and I'm going to ask everybody to please think about your 30-second parting shot for the day. But before I do that, there's a question here that I think is actually quite helpful, and it talks to a shareholder or investor activism. And this one says, picking up on Neil's point, is there a lot of scope for local advisors and fund managers to ask ESG questions of their investee companies and their prospective investment targets? Let me just let's ask the latest PRI signatory. Karim, do you have any view on this also as an asset manager? What is the scope for local advisors and fund managers to ask ESG questions of their investee companies and their prospective investment targets?
Well, in the public space, the public equity space, there is a lot of things, actually, much more than we thought at the beginning. So companies are willing to talk about that, and just to say that the Casablanca Stock Exchange, for example, has a booklet about the ESG practices, and you can see that many companies, including small ones, have actually an ESG policy that is quite interesting. So we can ask questions, and those questions are usually very welcomed.
Thank you.
Talking about the more exactly
is going to be helpful. I'm going to turn to you now, Koli, quickly, because I know that. So I'm kind of almost guiding your parting shot a little bit. But Karim's point on that, could you reflect for us in closing a little bit about the role of exchanges and how they can promote better consciousness of these things around advocacy, engagement, and the like?
Absolutely. I think there's no doubt that exchanges play a significant role, and I just caught the tail end of the previous session. Exchanges are doing a lot, and I think they should continue doing that in terms of the advocacy and creating that enabling environment and leveraging their convening power to get the various players together to try and develop new interventions. I think this is an area that's only going to grow, and exchanges should really, make sure that they're up to speed with the developments and can leverage the opportunities and help drive the change that we need.
Thank you for that, Koli. Rashid and then Neil, could I get your parting thoughts?
Look, I think that talking about maybe Morocco, we are really aware of the situation. I think that the market's still concentrated by institutional investors. I think that retail investors still have much a little bit portion of the market. There is a lot of effort to go through the notion of impact investing. I think that people now are trying to emerge, try to change by having ESG framework in their investment from top investment to down investment. I think that the ecosystem is going to maybe to wake up aware of the situation. We don't have the choice. I think we should really change our way to how we are acting, how we are investing, and how we are doing how we can doing things differently.
Sorry, Rashid, sorry, thank you. I was going to say, indeed, we don't have a choice, but let me leave the parting shot to Neil, because I know we're very close to closing now. Thank you.
Great, thanks. Thanks for a good discussion. I think the last thing I would say is that as the impact investing industry is developing, there's increasingly a wider choice of different products and different strategies with different risk return profiles. So whatever type of investor you are, whether you're a pension fund or an insurance company, or if you're a retail investor, you can find impact products, you can find investment products which will deliver a positive impact as well as a financial return with whatever financial and risk return parameters you're looking for. So I think the products are out there. I encourage people to look and see what can fit into their portfolio.
Thank you, Neil, and thanks to all our panelists. You've heard it here today. The terms green swan came from this panel today. We've heard about the fact that you don't need to be scared about it. There definitely is an upside. There is return alongside impact. And actually, do we really have a choice? So thank you very much for joining us today. Thank you very much to our esteemed panelists for the time you've taken to share these thoughts with us. And we're looking forward to a lot more impactful investing on our continent. We certainly need it. And thank you very much once more to the organizers for having us, the host, the Casablanca Stock Exchange. Thank you, and I hand back to the organizers for the afternoon.
Thank you very much, Shamila, and thank you to all our panelists for sharing their insights on the topic of impact investing for our last panel. So to conclude our conference, please join me in welcoming the President of the ASEA, Dr. Edo Kosi Amenunve, who will be delivering his closing remarks. Thank you, everyone.
invented electronic exchanges more than 40 years ago. What most people don't know is that Nasdaq is a technology company by its core. Today we provide technology to more than 250 clients in more than 50 countries across all types of markets in the world.
The partnership between SGX and Nasdaq is more than a decade now. We are a multi-asset exchange. Our business is vertically integrated and we have an international presence. Technology is no longer separate from business. It's really about how we are reshaping business.
Tabcorp's vision is to be the trusted gambling entertainment company. Our wagering business, Tab, is Australia's largest multi-brand wagering company across digital channels and retail. Nasdaq's merge pool technology allows us to bring new products and opportunities to our customers.
Dear Kamal Mokdad, Chairman of the Board of Directors of the Casablanca Stock Exchange, dear Tariq Senhaji, Chief Executive Officer of the Casablanca Stock Exchange, distinguished CEOs, members of the ASEA Executive Committee, distinguished members of the ASEA, distinguished partners and speakers, ladies and gentlemen. We have reached the end of the 24th Annual Conference of the African Securities Exchanges Association. For months, I have seen all the energy that has been deployed to make this virtual conference a reality. First of all, allow me to thank the Minister of Economy and Finance, His Excellency Nadia Feta Alawi, for her official opening remarks, which shows the commitment of the Kingdom of Morocco to support the development on African capital market. Thank you too to Madame Neza Hayat, Chairperson and CEO of the Autorité Marocaine des Marchés de Capitaux. It is once again an opportunity for me to congratulate the Casablanca Stock Exchange, our host, its CEO, Mr. Tariq Senhaji, and the entire team of the conference for their dedication toward the success of this event, regardless COVID-19 constraints. I would like also to express my deep gratitude to our partners, Direct FN, Nasdaq, and London Stock Exchange Group for their contribution to promote African capital markets. Ladies and gentlemen, during the opening ceremony, we heard from the Minister of Economy and Finance of the Kingdom of Morocco and from the Moroccan regulator, and that despite the challenges that we still characterize African markets, lack of debt, illiquidity, our markets are key for the recovery of our economies. Both leaders have called for cooperation among market participants and harmonization of regulatory frameworks. We are also reminded of certain global best practices that could potentially accelerate the development of African capital markets by increasing the number of IPOs and listings, encouraging retail participants, attracting international capital, such as investors' protection, and a call for more cohesive working relation among the market participants, including the government, regulators, and brokerage community. One of the greatest threats facing humanity today is global warming. And even thought very few African countries can be held accountable to this risk, the continent livelihood, agriculture, fishery, and irrigation is facing immense threats from it. We too have to play our parts to contribute to the global carbon budget. It is encouraging to see that more African exchanges are embracing green products in line with global agendas of combating climate change. The association equally supports the adoption of ESG guidelines among its members so as to encourage impact investing, especially in the backdrop of a pandemic. As such, our third edition of the Sustainability Report focuses on the effect of COVID-19 and the place of ESG guidelines in mitigating the risk and threats facing our markets. This report is now available on the ASEA website. Listing of state-owned entities have proven to be a success in fueling liquidity in more developed markets. It is for this reason that in collaboration with Oliver Wyman and IFC Morocco, we developed a report to make a case for more SOEs in Africa to come to the market. This report can equally be found on the ASEA website. As we live in a disruptive era, African exchanges too are called to adapt with the changing tides, either through technology or product and services offering, if we are to remain relevant. Some key trends highlighted include technological adaptation, digital currencies, introduction of asset classes, consideration of blended finance approaches, and market integration, among others. Lastly, Africa is still a SME market, and this sector of the economy is deemed very important if the continent is to transform from low income to middle income. And once again, it is encouraging to see that most African exchanges have SMEs boards as financing option for this key sector of the economy. I can assure you that the conclusions and the recommendations emerging from this conference will serve as a roadmap for African stock exchanges on the continent. To this regard, ASEA will continue to pursue the implementation of its strategic priorities so as to enhance and strengthen African capital markets. Also, in the next years, there will be more market studies and reports on topical matters impacting our market. I trust and hope that these studies will be used as tools to influence positively our capital markets. Ladies and gentlemen, I cannot conclude my remarks without congratulating all the participants in the 24th ASEA Annual Conference. We will soon announce the host of the 25th Annual Conference, so stay tuned. And now, as the year winds down, I take this opportunity to wish you all happy holidays and see you next year. Stay safe. Thank you for your attention.